Picture this. It's a Tuesday afternoon in suburban Phoenix, and Sarah is sitting in her real estate agent's office, hands trembling as she signs the papers on her dream home. She's stretching her budget to the absolute limit, paying 40% more than what this same house would have cost just 3 years ago. Her agent assures her that real estate always goes up, that she's making the smartest investment of her life. But what Sarah doesn't know, what most home buyers right now don't realize, is that she might be walking into one of the most devastating financial traps in modern history, because all the warning signs are there, flashing red like emergency lights in the fog, and they're pointing to something that could reshape the entire American economy. We're potentially standing on the edge of a real estate crash that could make 2008 look like a practice run. Now, I know what you're thinking. We've heard this before, right? People have been predicting a housing crash for years now, and it just keeps not happening. Prices keep climbing. People keep buying, and the doomsayers keep looking foolish. But here's the thing, this time is genuinely different, and I'm going to show you exactly why. We're not talking about speculation or fear-mongering. We're talking about a perfect storm of economic forces that are converging right now, in 2025, setting the stage for what could be a catastrophic collapse in 2026. And unlike the predictable patterns of past cycles, this crash is being driven by factors we've never seen combine in quite this way before. Let's start by understanding where we are right now. Because you can't see where you're going if you don't know where you stand. The American real estate market has been on an unprecedented run since the pandemic. When COVID-19 hit in 2020, something unexpected happened. Instead of crashing, as many predicted, housing prices explode. People trapped in apartments suddenly wanted houses with yards. Remote work made location irrelevant. Interest rates dropped to historic lows. And money, lots of money, flooded into the system through government stimulus and Federal Reserve policies. It was a frenzy unlike anything we'd seen since the mid-2000s. And that comparison should already be making you nervous. But here's what most people miss when they compare this to the 2008 crash. The fundamentals are actually worse now, just in different ways. Back in 2008, the problem was primarily bad loans, predatory lending, and financial instruments so complex that even the people selling them didn't understand what they contained. This time, the loans are generally better quality. Banks learned their lesson, regulations tightened, and the subprime mortgage crisis playbook got thrown out. So if the loans are better, how could things be worse? Because the problem isn't the quality of individual mortgages anymore. The problem is everything else, all at once. Let's talk about affordability, because this is where the cracks in the foundation become impossible to ignore. Right now, as we sit here in late 2025, the median home price in America is hovering around $430,000. Let that sink in for a moment. For a median household earning about $75,000 a year, that house represents nearly 6 times their annual income. Historically, their healthy ratio has been around 3 to 3.5 times annual income. We've blown past every reasonable metric of affordability, and we're in territory that simply cannot be sustained. When you combine these inflated prices with mortgage rates that, despite recent fluctuations, remain significantly higher than the pandemic-era lows, you get monthly payments that are eating up 50, 60, even 70% of people's take-home pay. That's not sustainable. That's a powder keg. Now, some people will argue that housing is expensive because there's a shortage, and they're partially right. We do have a housing supply problem in America. We've been underbuilding for over a decade. Zoning laws have made construction difficult in many desirable areas, and the shortage is real. But here's the critical nuance that everyone seems to miss. A supply shortage can explain high prices, but it cannot, by itself, prevent a crash. Let me repeat that because it's crucial. Supply shortage does not equal crash immunity. What matters is not just how many houses exist, but whether people can afford to buy them at current prices. And increasingly, they cannot. The economic pressure on American households right now is immense and growing. Real wages, when adjusted for inflation, have been stagnant or declining for most workers over the past few years. Yes, nominal wages have gone up, but they haven't kept pace with the cost of everything else. Food, energy, healthcare, education, and of course, housing. People are stretched thin, living paycheck to paycheck, with credit card debt at all-time highs and savings depleted. The pandemic savings that fueled so much of the 2021 to 2023 buying frenzy, gone. The stimulus money, spent. The excess cash that made 20% down payments possible, exhausted. We're running on economic fumes, and the engine is starting to sputter. Here's where things get really interesting, and by interesting I mean terrifying. Let's talk about what's happening in the commercial real estate sector, because this is the domino that most people aren't watching, and it might be the one that brings everything down. Commercial real estate, particularly office buildings, is in a state of crisis that hasn't fully materialized in public consciousness yet. The shift to remote work that started during the pandemic hasn't reversed. Companies have realized they don't need as much office space. Many have gone hybrid or fully remote. The result, all office buildings in major cities are sitting empty, hemorrhaging money, and their values are plummeting. Some estimates suggest that commercial office real estate has lost 30 to 40% of its value in major markets. Now, why does this matter for residential real estate? Because of how interconnected our financial system is. Major banks, pension funds, and investment firms have enormous exposure to commercial real estate. When those loans start defaulting, and they are starting to default, it creates a cascade effect through the financial system. Banks tighten lending standards, investment capital dries up, the domino effect begins. And here's the kicker. Many of the same institutional investors who have been buying up residential properties, turning single-family homes into rentals, and driving up prices, are the same ones with heavy commercial real estate exposure. When they need to raise cash to cover losses in one sector, they'll sell in another. And what do you think happens to residential real estate prices when large institutional investors start dumping properties to shore up their balance sheets? Let's add another ingredient to our toxic recipe. The coming wave of adjustable-rate mortgages and interest-only loans that are about to reset. Now, the volume isn't as large as it was before 2008, but it's still substantial, and in an environment where rates have risen dramatically, these resets are going to hit homeowners like a freight train. People who bought at the peak of the market with creative financing solutions are going to see their monthly payments jump by thousands of dollars. Many won't be able to afford the new payments. They'll have two choices: sell or default. Either way, it adds to the inventory of homes flooding the market. Demographics are also working against the housing market in ways that people aren't fully appreciating. The baby boomer generation, the wealthiest and largest generation in American history, is aging. Many boomers own multiple properties, their primary residence, vacation homes, investment properties. Over the next few years, we're going to see an increasing number of these properties hit the market as boomers downsize, move into assisted living, or pass away. This isn't speculation, it's arithmetic. The generation that accumulated the most real estate wealth in history is reaching the age where they liquidate that wealth. Meanwhile, the younger generations who would traditionally be buying these homes, millennials and Gen Z, are saddled with student debt, facing a tough job market, and priced out of homeownership at current price levels. The intergenerational wealth transfer that EST coming is going to flow smoothly into continued high real estate prices. It's more likely to create a supply glut at exactly the wrong time. Let's talk about something that doesn't get enough attention in these discussions: the psychological component of real estate markets. Housing markets are in many ways more driven by psychology than by pure economics. People buy houses because they believe prices will keep going up. They stretch their budgets because they don't want to be priced out forever. Real estate agents, lenders, and media cheerleaders reinforce the message that you can't lose with real estate, that waiting means missing out, that prices only go in one direction. This creates what economists call a self-fulfilling prophecy during the boom times. But psychology cuts both ways. Once the market turns, once people start to believe that prices might fall, the panic can be just as powerful in reverse. Buyers disappear overnight. Sellers rush to get out before prices fall further. The very psychology that drove prices to unsustainable heights accelerates the crash on the way down. Now, let's address the elephant in the room: the Federal Reserve and monetary policy. The Fed spent years keeping interest rates artificially low, pumping money into the economy, inflating asset prices across the board, including real estate. When inflation finally forced their hand and they had to raise rates rapidly, they created a shock to the system. Higher rates mean higher mortgage payments, which means fewer qualified buyers, which means downward pressure on prices. But here's the trap the Fed is in. If they cut rates too much to support the economy, they risk reigniting inflation. If they keep rates high to fight inflation, they risk triggering the very recession and asset price collapse we're discussing. They're threading a needle in a hurricane, and the margin for error is razor thin. The most likely scenario is that they make the wrong call, or that external events force their hand, and the delicate balance collapses. Speaking of external events, let's consider the geopolitical and global economic factors that could serve as catalysts for a crash. The world economy is increasingly fragile and interconnected. Tensions between major powers, potential conflicts, supply chain disruptions, energy price shocks. Any number of external events could serve as the trigger that pops the bubble. We've seen how quickly things can change. A pandemic that nobody saw coming reshaped the entire world economy in a matter of months. The next shock might not be a pandemic. It might be a financial crisis originating in another country that spreads globally. It might be a major geopolitical event that disrupts trade and investment. The point is, we're living in an increasingly volatile world, and the real estate market, sitting at these inflated valuations with all these underlying vulnerabilities, is extraordinarily exposed to any major shock. Let's get specific about the timeline and why 2026 is the critical year. Right now, in late 2025, we're in what I would call the tension phase. Prices are still elevated, but sales volumes are declining. Homes are sitting on the market longer. Sellers are starting to reduce prices, but only reluctantly and in small increments. Buyers are waiting, sensing that the market is turning but not yet confident enough to jump in. This standoff can last for months, but it can't last forever. Something will break the stalemate, and when it does, the market will move fast. Based on current trends and historical patterns, that breaking point is most likely to occur sometime in 2026. It might be triggered by a wave of foreclosures, a major bank or investment firm announcing massive real estate losses, a geopolitical event, or simply the accumulated weight of all these factors reaching critical mass. But the trajectory is clear, and the timing is increasingly predictable. What will the crash actually look like? It's unlikely to be a sudden, dramatic collapse like a stock market crash where everything falls 30% in a day. Real estate moves more slowly because houses are illiquid assets. You can't click a button and sell your house instantly. Instead, what we're likely to see is a grinding, painful decline over 12 to 24 months. It'll start in the markets that are most overvalued, places like Phoenix, Austin, Boise, many of the pandemic boom towns where prices rose the fastest. We'll see inventory spike as sellers panic and try to get out. Prices will start dropping, first by 5%, then 10%, then more. The media will initially call it a correction, a healthy normalization, but as the declines continue and accelerate, the narrative will shift to crisis. Banks will tighten lending even further, which will reduce the pool of buyers, which will push prices down more, which will cause more homeowners to find themselves underwater on their mortgages, which will lead to more defaults, which will push prices down further. It's a self-reinforcing cycle, and once it gets momentum, it's very difficult to stop. The human cost of this is what we really need to consider, because behind all these numbers and economic trends are real people with real lives. Remember Sarah from the beginning of our story. She's going to find herself in a nightmare scenario. The house she paid $450,000 for in 2025 might be worth $320,000 by late 2026. She'll owe more than the house is worth. She'll be trapped. She can't sell without bringing cash to the closing table, cash she doesn't have. She can't refinance because the house isn't worth enough to qualify. If her financial situation deteriorates, if she loses her job or faces a medical emergency, she'll have no good options. She'll join the millions of Americans who learned the hard way in 2008 that real estate doesn't always go up, that you can lose everything you thought was secure. The emotional and financial devastation of that experience ripples through families and communities for years. But it's not just individual homeowners who will suffer. The entire economy is at risk because of how central real estate is to American wealth and economic activity. For most middle-class Americans, their home is their primary and often only significant asset. When home values collapse, household wealth evaporates, people feel poorer because they are poorer, and they cut back on spending. That reduced spending hits businesses, which leads to layoffs, which leads to more people unable to pay their mortgages, which leads to more foreclosures, which leads to more supply on the market, which leads to lower prices. We spiral into recession, potentially a severe one. The construction industry, which employs millions, grinds to a halt. Real estate agents, mortgage brokers, home inspectors, appraisers, all the ancillary industries that depend on a functioning housing market, they all contract sharply. The ripple effects touch every corner of the economy. So what can be done? Is there any way to prevent this crash or at least to mitigate its impact? The honest answer is that it's probably too late to prevent it entirely. The imbalances are too large. The vulnerabilities too deep. We've been building toward this for years, and the momentum is extremely difficult to reverse. However, there are things that could be done to soften the blow. The Federal Reserve could try to engineer a soft landing, gradually bringing down asset prices without triggering a panic. Congress could pass legislation to help homeowners facing foreclosure, perhaps with refinancing assistance or temporary mortgage relief programs. Local governments could relax zoning laws to allow more housing and construction, increasing supply in a managed way. Financial regulators could force banks to recognize their commercial real estate losses sooner and shore up their capital positions before a crisis hits. But all of these require political will, coordination, and perfect timing, none of which we can count on. For individuals, the question becomes, what should you do? If you're thinking about buying a house right now, the safest course is probably to wait. I know that's incredibly difficult advice, especially if you're tired of renting, especially if you're starting a family and want stability. But buying at the peak of the market is almost certainly going to lead to financial pain. If you can wait 12 to 18 months, you'll likely have much better opportunities with lower prices and potentially better financing terms. If you already own a home, the calculation is more complex. If you have a low fixed-rate mortgage and you're not planning to move, you're probably fine staying put. Your paper wealth might decline. But as long as you can make your payments and you're not forced to sell, you'll ride it out. However, if you're stretched thin on an expensive mortgage, if you bought recently at inflated prices, you should be thinking about building up emergency savings, making sure your job situation is secure, and preparing for the possibility that you might need to make some difficult decisions in the coming years. The broader lesson here is about understanding market cycles and not buying into the myth that any asset class only goes in one direction. Real estate has been treated as uniquely immune to crashes in the American consciousness. Despite the fact that we've seen major real estate crashes before, the 2008 crisis should have been a permanent lesson. But memories are short, and the people selling houses have strong incentives to promote the idea that real estate is always a safe bet. It's not. Like any asset, real estate goes through cycles of boom and bust. We're at the end of a boom cycle and the bust is coming. That's not pessimism or doom-mongering, it's just how markets work. Trees don't grow to the sky. Prices can't rise faster than incomes forever, and eventually, reality reasserts itself. Looking at the international context gives us additional warning signs. Other countries are already experiencing real estate corrections. Canada, Australia, New Zealand, all countries that saw massive pandemic-era housing booms similar to America's, are now seeing prices decline, in some cases quite significantly. These are advanced economies with similar dynamics to the United States. What's happening there is a preview of what's likely to happen here. The global nature of the real estate bubble suggests that this isn't just an American problem. It's a worldwide phenomenon of too much cheap money chasing limited assets, and that money is now being withdrawn from the system. The correction is happening globally, and America won't be immune. There's also the question of what comes after the crash. Real estate crashes are incredibly destructive, but they also create opportunities. For people who have saved money and stayed out of the market during the bubble, the crash will present a once-in-a-generation buying opportunity. Properties that are unaffordable today will become accessible. Young people who have been locked out of homeownership will finally have a chance to buy. Investors with cash and patience will be able to acquire assets at reasonable prices. In that sense, the crash, while painful, is necessary to reset the market to sustainable levels. It's creative destruction in action. The economy can't function properly when housing is so expensive that workers can't afford to live near their jobs. When young families can't buy homes, when wealth inequality is exacerbated by older generations holding appreciating assets while younger generations are locked out. The crash will be painful, but it will also restore some semblance of affordability and opportunity. We should also consider the policy response that will follow the crash. Governments and central banks will not sit idle while the real estate market collapses. There will be intervention, bailouts, stimulus programs, attempts to stabilize the market and prevent a complete meltdown. The form this takes will matter enormously for how severe the crash is and how long the recovery takes. If policymakers learn from the mistakes of 2008 and focus on helping homeowners rather than just bailing out banks, the outcome could be less severe. If they make the wrong choices, or if political gridlock prevents effective action, the crash could be deeper and longer lasting. We can't predict exactly what policy response we'll see, but we can be certain there will be one, and it will shape the trajectory of the market for years to come. As we wrap up, I want to come back to Sarah sitting in that real estate office, about to make the biggest financial decision of her life. What would I tell her if I could? I'd tell her to slow down, to wait, to not let fear of missing out drive her into a decision she might regret for decades. I'd tell her that there's no such thing as a sure thing, that market cycle, and that sometimes the best decision is to be patient. I'd tell her that her financial security is more important than owning a home right now, and that opportunities will come again. But I also know that she might not listen, because the psychological pressure to buy is enormous, because everyone around her is telling her that real estate always goes up, because she's afraid of being priced out forever. And that's why this crash, when it comes, will catch so many people unprepared and hurt so many families. They're being told a comfortable lie when they need to hear an uncomfortable truth. The reality is that the American real estate market in late 2025 looks remarkably similar to the American real estate market in late 2006. The specific causes are different. The financial instruments are different, but the fundamental dynamic is the same. Prices have risen far beyond what underlying fundamentals can support. People are stretched to their financial limits, and everyone is convinced that it's different this time, that the party will keep going forever. It never does. Markets always correct. The only questions are when and how severe. Based on everything we've examined today, the weight of evidence suggests that 2026 is when the correction comes. And given how overvalued the market currently is, the correction will be substantial. We're not talking about a minor price adjustment. We're talking about a potential 25 to 40% decline in median home prices over 18 to 24 months, with some overheated markets seeing even larger declines. But here we are, standing at the edge of what could be one of the most significant economic events of this decade. The warning signs are flashing. The fundamentals are broken. The psychology is fragile. The external risks are mounting. All the ingredients for a crash are present and mixing together. Will 2026 be the year it all comes tumbling down? The probability is uncomfortably high. And when the history books are written about this period, they'll look back and wonder how so many people missed the obvious signs, how we convinced ourselves that this time was different, how we walked eyes wide open into a crisis that was entirely predictable. But that's always how it goes with financial bubbles. They're obvious in retrospect and invisible to most people while they're happening. The question is, are you going to be someone who sees it coming and prepares accordingly, or someone caught unprepared when the inevitable happens? The choice, and the consequences, are yours. The crash is coming. The only question left is whether you'll be ready when it does.